Hello and welcome to KYC, Know Your Company, a show designed to give the regular investor powerful, actionable insights into the fundamentals of a single listed company every day. And today we're going to talk about Federal Bank. It's in focus because there has been a reasonable amount of rejig, both on the leadership front, with Shalini Warrior was a key part of the leadership now choosing to step down. And you have KVS Manian, who was ex-Kotak Bank, who took charge in September of 2024, and now it's been 2 quarters since the time he's fully taken charge. What we're going to do is, of course, we're going to break down Federal Bank for you, and thereafter we're going to speak with an analyst to try and understand whether the commentary emanating from the company is reasonable in terms of expectations and whether it's achievable. We thought this is the better path to take. Because it will give us better perspective. There's enough commentary to talk about. So let's get right to it. What about Federal Bank? It's one of the oldest private sector banks in the country. 1931 was when it was incorporated. It was predominantly south-based, continues to be, operates through around 1,500 odd branches. The focus largely is South India. That's where it gets a bulk of its market share from. The market share, it's one of the top 3 banks, both in terms of loans as well as deposits in South India. So significant presence in that sense. We had KVS Manian, who now leads the bank. I did speak about that. September of 2024 is when he took over. Why is this important? Is because he is driving a huge change within Federal Bank. One, he's played a key role in Kotak Bank earlier, and a key role in their transformation from NBFC to bank. He's expanded retail banking at Kotak. He's also led corporate and investment banking at Kotak. So those sides of the business he has deep experience in, and therefore will be important to understand what he is trying to do at Federal, which I will come to, and thereafter we'll speak about execution, whether it's even possible or not. Now, in terms of how the loan mix is, corporate and commercial is around 1.02 lakh crores, around 1 lakh crore book, corporate and commercial. And then you have retail, which is a larger chunk. So 55% of the book is retail, around 45% is corporate. That's how the split is. The growth, as you can see, in retail is healthy and in commercial is healthy. Corporate is slightly sluggish. This is at least over the last year or so, and therefore these figures will give us a reasonable angle on what the company has done over the last 12 months or thereabouts. Within retail, where's the focus? Well, one is pure play retail, then there's specific loans, something like a gold, something like a business banking loan. So some of those aspects also come in. But this is more from a perspective to help you understand what are the segments that it currently caters to. If you look at the next graphic as well, we'll add, there you go, agri-allied CV, but very small, right, in CV, just 3,000 crore book, and MFI. Just about 4,500 crore book, and then you have MFI, which is around 4,000 crore in terms of book size. The growth there is obviously faster because it's off a low base, and therefore something that we'll have to keep in mind to see how the strategy will evolve going forward as well. But that's how the bank has shaped itself up, at least over the last year and historically. More south facing, and this is how it's split in terms of segments. Now let's talk about the factors that we look at. We'll first start off by looking at the income statement. Thereafter we look at the balance sheet. We look at operational metrics because those are important, and we look at asset quality as to how that has evolved, and we'll rate each of these parameters. We look at shareholding, valuations, the street coverage, and the street credentials. We'll look at all of that, and thereafter give a comprehensive assessment on what this looks like. Let's first start off with the income statement. And mind you, it's a relatively small bank in that sense, and therefore you would expect it to grow faster than mid-teens, but that's what it's done over the last 3 years. In an era where growth has been extremely strong, we've seen just about a 14.5% growth on the net interest income number. Operating profits even more tepid at just about 11%. What's really aided profitability is the fact that you've seen a sharp rise in your, a sharp fall in your provisions number, which is aided profitability. The other piece also to know is FY23 was a relatively better year than FY24, because FY24 or rather FY23-24 have largely been better than even an FY25, because FY25 we've seen sharp margin compression, and we'll talk about that in the operational metrics, and that will also somewhere reflect in profitability. So NII may be slightly compressed in that sense, but yet a 14.5% growth on the NII account leaves something on the table to be desired, and therefore we'll give this a neutral. We'll also look at the balance sheet. When we're looking at the balance sheet, again, you'll look at the growth on the advances, gross advances front, it's just about 16.5%. So again, in an era where at least the last year or two, maybe the last year has been sluggish in terms of loan growth, but prior to that, for a year or two, there was extremely healthy loan growth in the system. So you would expect a bank size of Federal to probably go slightly faster than a 16.5%. You know, and deposits have been even more tepid. It's at 13.5% on the deposit growth front. Look at the CASA, and the CASA ratio is even more difficult in that sense. The CASA ratio is just about 30% currently. So overall, we'll give this a neutral as well on the balance sheet count. Not the best when it comes to the growth that's coming through in the system versus what a medium-sized bank ought to grow at. Let's last off look at one metric, you know, in that sense is the operational metric that we look at. Within operational, you look at how yield on advances have crept up. Not surprising per se, but it's definitely a healthy inch up in terms of yield on advances. If we look at the annual yield on advances, it's moved up from 7.8% in FY22 to 9.2% in FY24. This is also on the back of the fact that you would have seen an inch up in the repo rate from FY22 to FY24. Mind you, April, May of 2022 was when the repo rate started to get hiked, and therefore some of that also spilling over on the yields. But you compare that to a cost of deposits, it's gone up from 4.1% in FY22 to around 5.5% in FY24. And when you're looking at the cost of deposits even now, you'll see the deposit cost inching up from 5.84% in Q1, it's gone to 5.92% in Q3. So just in a few quarters, you're continuing to see that pressure with regard to cost of deposits, and that is keeping a lid on margins. And now this is where it gets interesting. The net interest margin number, which was at 3.2% in FY22, inched up to 3.5% in FY23 because you had the repo rate go up, but deposit rates did not catch up very quickly, and therefore you had a lead lag for about a year. Thereafter, you saw it come back down. You saw it come back down to 3.3% in FY24, the margin number. And thereafter, we've seen even more margin pressure, as you can see in FY25, 3.16, 3.12, 3.11. And a lot of that has spilt over to the ROA number. Before I come to the cost to income, I'll talk about ROA. ROA, which was at 0.89% in FY22, inched up to 1.25%, went further up in FY24 to 1.31%. Why? Because of the credit cost number being extremely low. If you remember, in the P&L that we spoke of, the provisioning number was extremely low in FY24. If we have that graphic, let's put it out. Because FY22 provisioning was at 1,222 crore, FY23 was at 750 crore, but FY24 was just at 196 crore. And that was the number that actually aided ROA more than anything else. But FY25, you're starting to see an unwind on that particular number as well. And therefore, you're seeing ROAs come off 1.27 in Q1, 1.28 in Q2, but 1.14 in Q3. So you're starting to see an inch down with regard to ROAs. Can those ROAs sustain? because that will determine profitability for the company. That's something that we have to look out for. So operational metrics, not very impressive, neutral on the operational metric count as well. Let's look at asset quality. And now this is key for a bank, right? Would you want your asset quality to continue to improve? Yes, for sure. And that is exactly what Federal Bank has done. A clear thumbs up on this metric. From 2.8%, the GNP has come down to 2.1% in FY24. And thereafter, it's further inched downwards. And this is, mind you, in a difficult cycle as well. We are seeing pressure in some pockets in the lending industry. And despite that, Federal Bank is able to hold up fairly well. So that comfort is available. While they're doing lower margin product, they are also being able to control asset quality. So clear thumbs up on that count. In terms of margins as well, among the top 5 private sector banks, Federal Bank trades at a considerable discount in terms of margins. So if it has to chase the top 5 private sector banks, it has to considerably improve its net interest margins. NPA also very similar trajectory carried. Now the net NPA is down to just 0.5% at the end of Q3 FY25. So a clear thumbs up where asset quality is concerned. Let's talk about shareholding, and this is where also it's quite interesting. You look at the FII holding, when I'm looking at it over the years, it's come off, but March of 2022, it was at 26.01%. It continues to remain at around 26.3%. So largely that's how it's played out. We have an interesting set of investors in the FII basket as well, and I want to quickly talk about that. You have IFC, which is International Financial Corporation, which directly holds 4% and then has other funds through which it continues to hold maybe another 2 to 2.5%. So IFC Financial Institutions Growth Fund LP and IFC Emerging Asia Fund LP also hold 1% each in the company. So that's a decentish holding by IFC. Outside of that, you have Bank of Muscat India Fund. You have the Government Pension Fund, which used to own and some interesting names, obviously, as part of the old shareholding of Federal Bank, dated. But for the moment, IFC is the key large shareholder. Even among the DII basket, you have an HDFC mutual fund, which holds 7% in Federal Bank. So some good institutions which have a decent holding in the company from an investor perspective. So shareholding, neutral overall, no major promoter, but you have these institutions which hold a decent amount of shareholding within the company. That's one. Now, last couple of factors. Let's talk about street cred first. When we're talking about street cred, there you go. That's the last 1 month performance for Federal Bank. It's been a very strong performer when you're looking at it over the last year or so, 27% increase in the stock price over the last year. And we've also seen a decentish kind of return that the company has given over the last 5 years or so. In fact, the 5-year chart indicates it's been a multi-bagger, 322% returns from that 50 rupee mark, or rather it slipped even below 50. It was at 40, 45. It's currently sitting very, very pretty at 195. So it's made good returns for investors in that sense. And therefore, street cred has been rated as a thumbs up from our side. Let's look at valuations. This is again crucial because you have to look at valuations even from a perspective of how what's the kind of strategy that's been implemented. I'm going to quickly touch upon that. There's been a leadership change and there's been a strategy change. There's the leadership and strategy change now entails an improvement in margins. How are they going to do that? CASA ratio is going to go from 30% to 36%. They're going to improve on their CA composition from 6% to 10%. They're going to tap non-resident customers and non-South based customers. Those are two pockets of customers which they are doing well with. They're going to go outside that and tap those. Branches is going to be the way they're going to do it. 1,550 branches currently. They're going to hike it to 2,126 branches in the near term. They're also looking at, therefore, pushing higher deposits. Higher yielding assets is what they're going to do. Larger focus is going to be on vehicle loans, tractor finance, affordable housing. There's going to be an increase of fee income through forex, wealth management income, and credit cards. And your cost to income is eventually going to come down from 50+% to 41%. That is what is going to lead to a target ROA of 2.2%. They're going to bring down cost of deposits. They're going to inch up yield on advances. They're going to increase fee income, and they're going to do cost control on the top line. All of those should hopefully aid the ROA number. And therefore, it's currently placed in terms of valuations at 1.3 times, right in the middle versus some of the other mid to small banks. Slightly at a discount, or rather at a large discount to some of the larger private sector banks, and fairly so. If Federal Bank has to make that journey, it has to do a lot of execution, and if it does that, then likely it will command a premium in terms of valuations, and fairly so. And therefore, we'll give this a neutral because we want to see more execution, and whether this is realistic in terms of guidance or not, we'll obviously have an analyst, Rahul Malani, who will come shortly and speak to us about that. Last off is street coverage. Let's talk about that. 39 buy calls, 3 hold calls, 1 sell call. That's broadly how it stacks up. 14% upside. We'll give this a thumbs up. Very well covered, and a decentish upside as well, 12-month returns. Now let's talk about all the rating parameters that we've just spoken about. Let's stack it up. There you go. So you've got income statement, balance sheet, operational metrics, and asset quality has a thumbs up. And then you have shareholding, street cred, valuation picture, and street coverage, and that gives us a 5.5 on 8 on our KYC ratings. So that's how it stacks up for a federal bank. Now let's talk, let's go straight across. We have Rahul Malani, Senior Research Analyst at Mirae Asset Sharekhan, who's here to talk to us about exactly this. Rahul, you know, huge transformation that's expected from Federal Bank. First off, I want to understand from you, how are you looking at the overall strategy? And let me ask you a blanket question on what you believe the execution risks are to this strategy.
Yeah, good morning, first of all.
Good morning.
So, if we look at the compare the Federal Bank with some of the private frontline banks, operational performance has been a laggard for the Federal Bank. After the leadership change, the bank has outlined its revised strategy with coming up with improvement in the levers, improvement in the asset mix as well as the liability mix, where the focus is to improve the NIMs and the fee income part, which will really drive the operational performance in line with comparison with the other frontline private players. So it's a tall task. Execution is key, as you outlined mentioned, because 70 to 8, the bank is guiding for 70 to 80 basis points improvement in the ROA over the next 3 to 4 years. So we believe that at least 30 to 40 basis points is achievable, but 70 to 80 basis points is a tall task. While in terms of performance or performance over the next 2 years, we believe that for the strong re-rating in the stock, there is a need to improve the risk-adjusted returns that should be comparable with the front-end private banks. So outline strategies in line with that, in line with improving the risk-adjusted returns, taking into comparable to the private banks. But it will be a tall task over the period. But we acknowledge that we have to watch out from quarter to quarter where the execution is happening on the ground. And as and when the operating metrics starts to improve gradually over the period, there would be certain partial re-rating over the next 2 years in this period. In terms of valuations are reasonable for Federal Bank, while overall execution is at this point of time is key. And at this point of time, we will like to give a positive probability to execution, because after the leadership change, almost we have a veteran from the banking sector who has almost experience of more than 3 decades working in the Kotak Bank. So we will like to assign a positive probability towards execution, and we will ramp up we will look at quarter to quarter improvement in the operating metrics as and when it starts to report in the performance.
Taken. Rahul, one key concern at this point is with regard to margins. They had spoken 3 quarters, 4 quarters ago under erstwhile leadership that margins will not fall below 3.2%. It thereafter fell at 3.19. They said a few basis points here or there. Now it's fallen at 3.11%. The margin pressure seems to continue. Now you have a repo rate cut as well, which has come through, which should further accentuate the problem. How should one look at margins for Federal Bank? And is that at all a concern for you from an analyst perspective? What are you building in terms of the margin number for FY26?
See, clearly in FY26, there will be a margin compression of around 20 to 25 basis points if there is a 100 basis points cut in the calendar year overall for the Federal Bank. So clearly there will be a margin compression because 50 to 60% book is linked to the external benchmark rate, and then repricing. If you look at in the last higher interest rate cycle, when the rate starts when the RBI started to increase the rate from May 2022, we had seen a sharp increase in the yields for Federal Bank because they are more sort of their higher share of book is linked to the external benchmark rate, and then they are the revision time period is relatively smaller for the Federal Bank. So clearly, in terms of this quarter four also, you will see a much higher compression in the NIM for Federal Bank. Over the medium term, as I alluded that when company is speaking about improving the liability mix in the form of improving the CASA share from 30% to taking it to 35-36% levels, and then start focusing on mid-yielding assets, like for example they will now focus on the used CVs, used vehicles, lab, tractor financing, micro lab loans, so which they are earlier didn't do, which have certain partially higher yield, but in terms of risk also, the risk is manageable other than the unsecured book stands. So risk is lower than the unsecured book, but partially higher in yields. So overall over the medium term, at least from the at least 2 to 3 quarters after that, we should see if that execution is happening on the liabilities or the asset mix, and then we can decide upon the same.
Point taken, but 25 basis points is a large decrease to the already established floor that they had guided for. So you'll see margins fall below the 3% mark. And how realistic is this increasing of CASA from 30 to 36%? Are we building in too many risks into this, Rahul? Because you have an ROA problem then. You would likely say that ROA in the mid to near term has peaked, right?
Yeah, your conclusion is right that ROA has peaked in the near term, at least for the FY26 versus compared to the FY25. But I have spoken of 20 to 25 basis point over the period of cycle. That is for the if when I'm taking into account the 100 basis points compression, 100 basis point cut in the repo rate cut. So overall, in this quarter, we should see 5 to 10 basis points compression in the margin for Federal Bank. And at this point of time, there is no lever because they are into their investment phase. OPEX should be elevated. Credit cost is already at the rock bottom, around 40, 30, 20, 35 to 40 basis points of credit cost will be there. So there are no certain lever to offset that compression in terms of ROE. So
Correct.
basically,
yes, Rahul, complete your point, please.
So basically, I don't find any levers to counter that NIMS compression. So yeah, there will be a ROA compression led by NIMS compression in the near term, in the at least coming quarters.
Point taken. Faster growth, Rahul, is what Federal Bank offers. But when I'm comparing valuations of a Federal Bank with some of the PSU banks, some of the PSU banks looking better, all on margins, even maybe a bit more comfort with regard to ROA metrics. You also, so because you don't have ROAs peaking or rather peaked in the past, and now falling trend line on ROA, that's not reflective, right, on some of the PSU banks. More comfort, more safety. So is Federal Bank therefore a decent bet at this hour, given that you have 1.3 times price to book is what the stock is trading at, and you have so many risks which are yet to play out?
See, basically, in the near term, we believe that the valuations are full for the Federal Bank.
Okay.
But over the medium term, as I alluded that at least if there is certain improvement in the asset mix as well as the liability mix, NIMS improvement will be there in the franchise, which will lead to higher operating profits. So which can lead to improvement in the ROAs. From that perspective, if we take a bet for at least 2 years, then we may see that the Federal Bank appears to be a reasonable bet for at least for the medium term perspective. But as you alluded in the near term also, in the near term, basically all the mid-sized private banks would see higher compression because of the weak liability mix, weak liability franchise compared with the large private banks or PSU banks per se compared.
Point taken. Thank you so much, Rahul. Rahul, one quick question. If margins were to compress by 25 bips, what will the ROA therefore compress by? And of course, credit costs start to normalize.
We don't see ROA falling below 1% for Federal Bank.
Okay.
in
Okay.
FY26.
Okay. Point taken. Okay. Thank you so much, Rahul, for coming in, giving us that perspective. And you know, completely out of time on this edition of KYC on that note. Hope you found this helpful. Hope you found this insightful. But completely out of time from myself, everyone who puts the show together. Thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.